Back to the Money Pros. On this first show of 2014, we're taking a look back at what happened in investment markets over the last 12 months. With me now is Matt Dalton. He's CEO and managing partner of Belhaven Investments, a municipal bond manager in White Plains, New York. Matt, thanks for being on the show with us.
Thanks for having me back.
You were on our very first show, right?
Yes.
So this is a little bit of Money Pros nostalgia, so it's great to have you. You guys manage $1.8 billion in municipal bonds, so you certainly know what you're talking about when it comes to the bond market. We just heard about how the stock market did in 2013. It was really a fantastic year for most equity categories. How did the bond market do in comparison?
Bond market had a rough year, but not as rough as it had in 2008. For the most part, depending on the asset class you were working with, you saw negative returns of anywhere from 8% to flat for the year. Some areas you were slightly positive, but it was a rough year.
What were just in general, the headline kind of factors that caused the bond market to have a flat to down year versus the equity markets, which were driven by economic recovery and had actually a very good year?
Well, the Fed has been a big component of it. The taper has been the focus. The Fed is likely to be done tapering by October of this year. When they announced that they were going to taper, that bombshelled the bond market, and you saw interest rates rise. The 10-year Treasury bond touched a low of a 160. Today it yields a 288. It's been as high as about a 305 here recently.
So I think that's important for our viewers to understand, is because a lot of them may not be all that familiar with what the Federal Reserve is doing in the open market, but their activities have really, over the past several years, up until 2013, have resulted in really driving interest rates down. And they've seen that on the credit card rates, they've seen that in their mortgage rates, if they refinanced or if they have floating rate mortgages, things like that. So those falling interest rates were actually really good for bonds over the past several years, right? And now that when you're talking about the taper, what you're saying is that the Fed is pulling back on those open market activities, and so interest rates are going up, and that's what's causing bond prices to go down. Do I have that right?
That's correct.
Okay.
When interest rates rise, the value of your bond goes down.
So fixed income investors really need to keep that inverse relationship between interest rates and bond values in mind.
Correct.
Are there particular sectors of the bond market that did better or worse than others? I mean, just like the stock market that has a lot of different categories, the bond market is equally diverse. We got to dig down a little deeper rather than just talking about bonds in general. How did various sectors of the market do?
Well, I call it the bookends. The municipal bond market took both sides of it. Muni bonds were up slightly for the year. In most cases, they might have been flat or down, but you can find some sunshine there. The worst performing sector in the bond market was taxable municipal bonds.
Okay.
The sequester had a fair amount to do with that. Some of the Build America bonds that were issued after the 2008 debacle to get stimulus going and allow municipalities to borrow money had a call feature that if they didn't get the reimbursement from the government that they were promised, they had the right to call. And that blew a pretty cold wind through the taxable municipal bond market.
Okay.
So munis had both sides of the spectrum. And
The tax-free is good, the taxable is bad, and then in between
exactly. In between you had everything else.
Okay.
Corporate bonds, treasuries, mortgage-backed securities, agencies, they all were in the middle of that, all negative for the year.
Do you find yourself having to remind people, though, that a bad year in the bond market is not the same thing as a bad year in the stock market? I mean, you talked about categories down 8%, and that's a pretty lousy performance for bonds, but that could be just another drop in the bucket when it comes to stock market performance. Do you have to remind people of that?
You do. I think people forget that a bond is just cash flows. You are purchasing future cash flows.
Right.
That you know when you're going to get paid, you know when they're going to mature. When you're dealing with an individual security. A little different when you're in a mutual fund. It doesn't have a maturity, it's more perpetual, but you are going to get the income. It's a paper loss. You have to remind people that. They see a drop in the value of their bond portfolio and they lose sight of what the intent was in the first place, which was this is a safer area, enjoy the interest that you're earning, you will have
Don't
bond
forget, you
maturity.
have those cash flows that you're going to get regardless
right.
of what interest
That's
rates do
right.
and things like that. All right, for more information on the bond market in 2013, visit our website at foxprovidence.com. Click on the Money Pros. Next up on our financial roundtable, I'll be joined by both of our guests as we continue our review of investment markets in 2013. We'll also take a look forward to what we might expect this year. All that and more when we return right here on the Money Pros.